Welcome to RenMac Off Script, where we open to discuss markets, economics, policy, history, and life. It's the 30th of August, 2024. I'm Jeff DeGraff.
And I'm Kevin Dempter.
So we've got a special guest with us today. Kevin Dempter is one of my associates, colleagues. He's worked with me for, I was trying to think about that, Kevin. How long have we been together now?
You want to know something? It's 10 years in September.
Wow. Mazel tov, as they
10
say.
years.
That's
Yeah.
amazing. Good. Well, we'll have to get you what is it, a gold watch, a
Sounds
plaque,
good.
put a plaque up in your house since you're working from home. That'll work out great. Your wife
Yeah.
will love it. Put it right on the bedroom door. That'll be fantastic. So the rest of the crew is out on vacation. Of course, the guys that really work are right here today, as we always do every single day. We're just here chiseling it out, hitting the hammer on that chisel, trying to grind it out. But Kevin's a great observer of markets. He's got a lot of experience and has a strong eye. I would say, your only fatal flaw really is that you're from Philly. That's the only thing that really jumps out to me as troublesome.
Yeah, it's not my best quality,
I
but
mean,
I also live in Dallas, so a Philly fan in Dallas is it's a tough
that's
one.
that is tough, no doubt about it. Well, I'm
Yeah.
from Kalamazoo, Michigan, so you can't really throw stones from Kalamazoo, Michigan, no doubt about it. But as we go through and look, Kevin, and we talk every single day. I don't know if people know that, but we have multiple conversations every day, and some structured and formal, and others are just kind of Bloomberg IMs, et cetera. I think the challenging part, and we should just talk a little bit about how we see the world here, is that we do have a lot of bullish things happening, right? But at the same time, under the surface, those bullish qualities aren't quite as robust as what they were, say, in May. Certainly not as robust as they were back in, say, January of this year. So the equal weight S&P is making a new high. The ACWI, which is ex-US, is making a new high. That's the global markets. All those things are confirming trends. But as you go through and look at what's happening, what really stands out to you? Clearly I have some views here, but I'd like to get your interpretation of what you're seeing in the markets that jumps out as kind of maybe an oddity here, given the fact that the equal weight S&P is at a new high, that the ACWI is at a new high. What really leaps off the page to you?
Well, I'd say what stands out the most, number one, is what we're seeing on a relative basis for tech. So I think tech is starting to show signs of a relative top, which suggests that it's going to underperform further. And then on the flip side, healthcare is starting to look a lot better. I would say XBI, that's a chart we've been watching for a while. We've been bullish in that space for, probably 6 months, but it looks like one of the best ETFs in the market right now. XBI is getting close to breaking out. It's been getting close to breaking out, but it really looks poised to do so soon. And I think if it does break out, there's probably an easy 10% higher in that group. And we've seen that. We know that healthcare tends to benefit when tech lags. So we think there's still room for that trade to run. And then I would just say, what we're seeing in small caps, they're starting to outperform. The chart looks great. We'll just see if that can hold on. I think that's the big question here.
Yeah, that's part of the kind of the breadth of the market, but certainly between call it the end of the half, the end of June, and where we are today, there has been notable deterioration in a lot of tech, and you're seeing it as an example in European tech, right? I mean, the European tech names on a relative basis look weaker than they do, in the U.S. Conversely, the European healthcare names, the APAC, Pacific Rim healthcare names look better than they do here in the U.S. And I think there's a very clear from the data that we've looked at, which I think kind of from a high level, the way that you want to think about the world after the first Fed rate cut, right? So going back to 1957. There have been 15 rate cuts, first rate cuts that I should say. So whether you cut 3 times or the Fed cuts 10 times, we're just measuring the first cut in the cycle. And there's been 15 of those. And, on average, the market is actually flattish 1 month out. It's down a little bit 3 months out. The median is actually about flat, a little up, and then the 6 month out period is also call it about less than 2% up. So it's not a lock that the Fed cuts rates and the markets go up. But I think the most telling from a style perspective is what happens to the cyclicals versus defensives, right? I mean, that was very, very clear that on a 6 month forward basis, again, after the first Fed rate cut, you're talking about cyclicals underperforming defensives by almost 500 basis points, out 6 months. So the mean and the median are locked. In other words, there's not skew. There's not, one big event to the downside that's kind of driving those average returns. It's very, very consistent. And I think that's what we've seen in the last, call it 2 months of this market. The breakout in utilities, the breakout in real estate, the continued improvement in financials. Obviously, all these are interest rate sensitive, but they've come at the expense of, I'd say, discretionary and tech. What are some of, as we kind of go through the list, looking at the sectors, where would you put energy as an example of the strength of trends in energy? Bull, bear, or neutral?
I would say bear. I mean, you can just see on the relative basis, energy's been stuck there at the relative lows for a while. I would note in energy, though, that they tend to have a strong reaction to the election. So I think, you can see some more sideways action in energy up until the election. And historically, they tend to outperform right after right after the election. So I think there is some hope for the sector, maybe after the election, but until then, I think it's a bearish neutral at best.
And how do you look at materials from a relative standpoint here?
Materials are tough because you have gold and silver within materials, but outside the precious metals, the sector is still pretty weak. But gold looks amazing. The gold miners, the GDX ETF is getting close to breaking out on a relative basis versus the broad market. So we really like that space still. But the rest of materials are mixed at best.
And industrials, that's probably the hardest one.
Industrials are hard. We've noticed that the commercial and professional services groups have started to outperform, which they can be a little more defensive. So that kind of plays into the strength we're seeing in defensives. But the sector is holding up well. There really isn't anything notably that's breaking down. I think Deere is one that looks a little toppy, but for the most part, industrials still look pretty good.
And then we know that, historically they're very, very early cycle, and we haven't seen anything out of them yet. But consumer discretionary, as we get, if the Fed pushes this a little too far, and I think they actually might be setting up well for, say, a November, December trade, but I think it's too early here. Where do you see this pockets of strength and weakness in consumer discretionary?
Well, I would say if you just look at the XRT, it's the equal weight retail ETF. It looks like a potential big basing pattern, and it's looked like that for a while, but it hasn't been able to break out. It's starting to lose its relative strength. So that's a little suspect there. Outside of retail, I think the hotels and casinos look very vulnerable. I think there's some of the best sales in the market right here. But as far as an area of strength, I think the restaurants are starting to improve. McDonald's is getting close to the highs again. So yeah, if I'm looking for some longs in discretionary, I would look at the restaurants.
Yeah, I think the good news from, going through these charts is just the, call it, relentless strength that we've been seeing out of financials, right? Banks have been strong. They tend to do okay after the first Fed rate cut. Financials in aggregate aren't really anywhere. They're about flat versus the market after the first Fed rate cut. But I think the relative performance here has been really, really notable, and the breadth of the relative performance. When we rank, we quantitatively rank based on technical characteristics that we find to be predictive for stocks. When we put those in our ranking for financials, it's the largest group. They've got the most bullish charts in aggregate of any group, even well above tech, and just above utilities and REITs here. So I think that's great news. As we look at the market and this kind of shift towards more defensive characteristics, one of the things that keeps coming up time and time again from clients is, well, what happens if we have a soft landing? And what's interesting is I think 1995 is probably the poster child for the soft landing scenario, and we wouldn't even argue that that's an outlandish call here. That makes some sense. The risk is obviously, given that inversion of the short rates to the Fed funds, is that the Fed is on hold for longer or makes a policy mistake. And I actually worry that maybe the good news from this point as we go forward ends up really being bad news, which is if we've got a 130-point inversion in the 2-year yield and we keep getting good GDP figures, we get, maybe inflation that's not coming down as readily, even though the trajectory is right. If the retail sales figures continue to be robust, is there a risk that the Fed overstays their tightness given what the markets are telling us through the 2-year yield? And does that end up being the policy mistake? We'll see. But that's one of the things that certainly we're considering here for the remainder of the third quarter and into the fourth quarter of next year. But getting back to 1995, which I think is important, the Fed cut rates in 1995, in the July of 1995, and that was after we had a nice long consolidation, really this preemptive tightening that they had, and that was the soft landing. But from that point, from July, the early part of July of 1995, on a 3-month basis, cyclicals underperformed defensives by almost 10%. On a 6-month basis, they underperformed by 12%. So even though you stuck the hard landing and kind of the poster child for hard landings, the market didn't really react in a way that would be consistent with, I think, what people would default as the narrative for how things, quote unquote, should work in that environment. So I think it's one thing to keep in mind. Anything out there, Kevin, that you're seeing that says, hey, this probably is a soft landing, or maybe conversely, anything that you're seeing that says, hey, this has the risk of being a much harder landing than maybe the consensus sees it?
Well, I would say just what you're seeing in small caps. I mean, the fact that that's a big basing pattern, there's a good chance that it makes a run at the old highs. I think that probably says more than anything that we're going into a soft landing. But then on the flip side, I would say when you look at semis, with the equal weight SPX hitting new highs, semis are showing some of the worst momentum in the market. They have less than 30% of their issues are above their 65-day moving average, which is the worst in the market as far as industry groups go. They have less than 50% of their issues above their 200-day moving average, which is one of the worst in the market. So, that's a little concerning when you see some of these mega caps, and semis that are starting to deteriorate, because you wonder, okay, if you're going to have Nvidia start to fall off and some of these other mega caps, will the broad market hold up? And I doubt it. I don't think the market's going to be able to hold up as these names come in. So that'll be important to watch.
Yeah, I would say, and the small cap's a really important point because they tend to be more aligned with the credit cycle. They tend to be more dependent on the benevolence of their local bankers, their regional bankers, more than going or accessing the capital markets for financing. So I think that's a really, really important point. The other two things I would throw out there in conjunction with that would be triple B spreads continue to act well, right? I mean, they're not at the cycle lows, but they've really recovered at least 50% of the backup that they saw around the concerns around the yen. And then just those financials, the strength of financials, particularly banks, just says that these concerns about massive holes in the balance sheets from real estate, particularly from regional lenders. Maybe it's isolated, but it certainly doesn't seem to be a systemic problem. And, the credit cycle itself with write-downs and kind of those deeper recessions that start to impair balance sheets just don't seem to be there. So I think both of those are important and obviously worth noting as we continue to play it out. From a seasonal standpoint, I know this is kind of right in your bailiwick, if you will. What happens seasonally, and when should we start thinking about the lows being in place just from the calendar? If we were to take the calendar and say, hey, here's where we're long, here's where we're short. Where do we start to, obviously we're in a seasonally weak period right here. Where do we start to look at the calendar and say, this is where we need to start adding to exposure here to the upside?
Well, next month is historically the worst month for the market. Specifically, the second half of September tends to be worse than the first half of September. But just keep in mind, there's an election in 2 months. So I think there's going to be, I don't think the risk appetite ahead of the election is going to be too high. So I wouldn't be surprised to see just some tight consolidation, maybe drift lower into the election, kind of like how the market acted in 2016 before Trump won. So if you remember, the market made new highs, I think, in August of 2016, and then drifted lower right up into the election, had about a 5% correction, and then popped right after the election. So I wouldn't be surprised to see something like that happen.
Yeah, that's obviously a big unknown with the election. It's interesting because the weakness, the seasonal weakness, does tend to spill over into October during presidential election years. I mean, it's always there, but you usually make up for it in the second half of October, and that doesn't seem to be the case. Usually the low is in before the election, but is still some weakness really throughout most of October as it goes. In terms of the Fed, we're looking at 2000. I'm sorry, we're looking at September 18th as the likely date. I know Neil's not on here. Anything that you're seeing that would push that off or suggest more urgency that's needed from them?
No, I mean, to me, it looks like they're going to be on schedule here. At least cut 25 basis points in September. Um, that's more Neil's world, but we'll see. I know the market wants 50. I think 25 would be a disappointment. 50 would be very bullish for the market. But we'll see.
Yeah, indeed. Well, no doubt that the markets are giving us that little taste of that slowdown, and we'll see if the Fed meets the demands of the market with the 2-year yield and trying to close that gap between where they are and where the market says that they should be. So that'll be important. Kevin, enjoy the Labor Day. Thank you all for listening. We'll be back next week with the usual crew and the politics and the economics and the markets and all the yuck. Anyway, we'll be back then next week. Have a great Labor Day.